All right, let's talk about something that's on pretty much everyone's mind right now, navigating this wild economic landscape. We're going to build your personal playbook for these uncertain times. Let's jump right in.
I mean, this is the question, right? You see the markets shaking, prices for everything are going up, and you're probably wondering, how in the world do I protect my money through all this?
And look, this isn't just you feeling like things are more expensive. The numbers back it up. We're talking about an 8.3% year-over-year inflation rate, according to the U.S. Bureau of Labor Statistics. Now, that number comes from a whole mess of things: supply chains, global conflicts, you name it. But the bottom line? It's a real pinch on your wallet on every single household budget.
So, to help answer that huge question, we've done the homework for you. We've dug into what the experts at places like RBC Wealth Management and Smart Asset are saying, and we've boiled it all down into one clear, step-by-step guide. Think of this as your playbook for getting through these choppy waters. Okay, so where do we start? Well, first things first, before we dive into stocks and bonds and all that, we have to start with the stuff you can actually control, right here, right now. And that's all about shoring up your own financial foundation.
The big idea here is getting a handle on your cash flow. And it really boils down to 4 key actions you can take at home. First, you've got to create a budget, but not a rigid, set-in-stone one. It needs to be flexible, something that can change as prices change. Second, you really need to go after any high-interest debt. I'm talking about credit cards. With interest rates climbing, that stuff can eat you alive. Third, take a hard look at where your money is going. You know, the non-essentials. Those daily coffees, the streaming services you forgot you had, they add up fast. And finally, just try to shop and drive smarter. Making a simple shopping list can save you from impulse buys, and being a little more conscious about your driving can save a surprising amount on gas.
And this is so important to remember. A budget isn't something you just set and forget. It's not a one-time thing. It's a living, breathing tool. You have to keep tweaking it, fine-tuning it as your own life changes and as the economy keeps shifting.
Okay, so once you feel like your personal finances are on more solid ground, we can start talking about your investments. The big question here is, how do you build a portfolio that can actually take a punch when the market gets rocky?
You know, it's interesting. During times like these, a pretty predictable pattern starts to play out. It's almost like a tide of money flowing out of the riskier high-growth stuff. Think tech stocks or travel companies, and into things that just feel, well, more stable. This is what you hear people call the classic flight to safety. Investors are basically looking for a safe harbor to park their money, and they find it in things like gold, government bonds, and companies that sell stuff we always need.
So, what exactly is on this safe haven roster? Well, gold is the classic. It's a physical thing, it's been valuable for thousands of years, and it exists outside the regular financial system. Then you've got government bonds, especially U.S. Treasuries, which are basically seen as one of the safest investments on the planet. Next up are consumer staples. We're talking about the companies that make the food, the toothpaste, the toilet paper, the things people buy no matter what the economy is doing. And yeah, it makes sense that during times of global conflict, defense and aerospace stocks often get a boost from increased government spending.
Just so we're all on the same page, let's nail down what a safe haven really is. It's just an investment that people tend to run to when the markets get crazy and chaotic. The goal here isn't to get rich quick, not at all. It's all about capital preservation. It's about protecting what you have and keeping your money safe when it feels like everything else is dropping.
But playing defense is only half the game. And this might sound a little counterintuitive, but all this chaos in the market can actually create some really interesting opportunities, if you know where to look. And this quote from RBC Wealth Management really nails it. They point out that some sectors, like oil companies, can do more than just weather the storm. They can actually act as a strategic hedge against the exact risks that are causing all the problems in the first place.
So what exactly is a hedge? Well, it's a super important tool for managing risk. Think about it like this. Let's say you bet on your favorite team to win the championship. A hedge would be like putting a small, separate bet on the other team, just in case. If your team loses, you're disappointed, but at least you don't lose all your money. That's what a hedge does in your portfolio. It's an investment that's designed to go up when another part of your portfolio might be going down.
Okay, so how do you actually put this into action? Well, here are 3 strategies to think about. First, you could look for undervalued stocks that pay a dividend. These are companies that the market might be overlooking right now, but they still pay you a regular income, which is a nice cushion. Second, you could think about those geopolitical hedges we mentioned, like energy companies. When global instability pushes energy prices up, these companies can do well. And third, you can focus on those recession-resistant companies, the ones that sell things people need no matter what, like healthcare, basic food products, and utilities.
All right, so we've talked about shoring up your household finances, and we've talked about investment strategies for both defense and offense. But honestly, none of that matters without the single most important piece of the puzzle, your mindset.
And that brings us to this really crucial practice called portfolio rebalancing. Now, this has nothing to do with chasing the latest hot stock. It's the exact opposite. It's the disciplined, kind of boring process of selling a little bit of what's done really well and buying a little more of what hasn't, to bring your portfolio back to its original plan. The whole point is to keep your risk in check, not to try and time the market.
And this really lays it all out, doesn't it? You've got two completely different ways to approach this. On one side, you have emotional investing. That's when you let fear and greed take the wheel. You panic and sell when things dip, you chase trends that are already over, you react to every scary headline. And on the other side, you have disciplined investing. That's where you follow a plan, you focus on your long-term goals, and you tune out all the day-to-day noise.
And you know what? This final quote really just says it all. For anyone investing for the long haul, the most reliable strategy hasn't changed, even with all the scary headlines. It's always been about staying invested, making sure you're diversified, and actually using these downturns as an opportunity to add to your positions. That's the playbook that has always worked.
So that's what we want to leave you with. Take a second and ask yourself, is your financial plan built on a real strategy, or is it built on stress? Because honestly, the answer to that one question could make all the difference in the world for your financial future.